Hello friends, welcome again. Friends, as you have seen in the previous video on impact of COVID-19 on Indian economy, that the GDP growth rate of India touched 11-year low growth in the last financial year 2019-2020, ended on 31st March 2020. Though this growth rate cannot be entirely attributed to this COVID-19. In this video, I am going to talk on immediate impact of this pandemic, COVID-19, on growth of 8 core industries and net financial assets of household sector. Dear friends, as you may be aware of the fact that these 8 core industries constitute 40% of output of index of industrial production. Dear friends, in this table, you can see these are the 8 core industries, that is coal, crude oil, natural gas, refinery products, fertilizers, steel, cement, and electricity. And these industries are considered as the backbone of industrial sector. Let's have some fact checking on the official numbers released by the government on these industries. In the month of March and April 2020, all 8 industries recorded negative growth, except coal production, which grew by 4% in March 2020. As you can see in the table, that the highest fall was recorded by uh, cement and steel in the month of March and April. Further, it is only in case of fertilizer production that there is a little improvement in the month of April over March. You can see here it is minus 4.5, whereas in March it was minus 11.9. So there is a little improvement, though the growth rate is negative. Dear friends, in this figure, you can see the graph shows the average growth of core industries from April 2019 to April 2020. And you can see in the beginning, April 2019, it was 5.2%, and it is slowly going down. And in this period, it is recorded as negative, that is August, September, and October, the growth rate was in negative. Again, the growth started picking up, and these industries grew positively till February, when the growth rate was 7.1%. But in the month of March, we saw a fall of 9%, negative growth by 9%, whereas in April, we saw a large fall in the overall production of these 8 core industries, and it reduced to minus 38.1% because it was the month of full lockdown. Dear learners, now in this table, you can see the comparison of growth rate of core industries in 3 years. That is 2017-18, 18-19, and 2019-20. And most notable point in this table is the positive growth of fertilizer output. You can see here it the it grew by 2.7%, much higher growth in comparison to the previous 2 years growth. It was 0.3% in 2018-19, and even less in the year 17-18. So you can say that the fertilizer industry is not affected by the pandemic or lockdown. This may be because the impact of pandemic is more in urban metropolitan areas, and that too concentrated in few states. But impact is very much visible on the output growth of steel, cement, and electricity production because of lockdown. You can see here the growth rate. is very less. Steel 3.4%, whereas cement is in negative minus 0.9%, and electricity merely 1%. And if you look at the overall growth, the overall growth of core industries recorded as 0.4% only in 2019-2020, vis-a-vis previous 2 years growth of more than 4%. Here it is 18-19 4.4%, and 17-18 it was 4.3%. Dear learners, now in this slide we will see the status of financial assets and liabilities of household sector, which is also a benchmark macroeconomic indicator. In general, household sector is the major saver or depositor and significant borrowers in the economy. You can see in this table the gross financial assets. This gross financial assets include deposits and investments by the household sector. And you can see here it was 21.23 lakh crore in 2018-19, which increased marginally to 21 lakh 63,000 crore. So in absolute term there is a increase, but if you see in percentage term as a percentage of GDP, the growth in 1819 was 11.1, whereas in 1920 it fallen down to 10.6%. Now if you look at the financial liabilities of the household sector, here there is a drastic change, sharp decline. The in the year 1819, financial liabilities, that is borrowings by the household sector, was 7.5 lakh crore, which went down, plummeted to 6.01 lakh crore. So there is a huge fall by 1.5 lakh crore around. And if you compare in percentage term, as a percentage of GDP in 1819 it was 3.9%, whereas uh, in 1920 it gone down to 2.9% only. So this is one of the important reason because of which the net financial assets of household sector increased. According to RBI, a significant decline in the share of borrowings from the banking sector uh, in total liabilities during 1920 reflected the economic slowdown and risk aversion of banks. And during slowdown, we know that financial institutions also become more cautious in giving loans. So this trend leads to further economic slowdown. If you look at the net financial assets of the household sector, it is increased by 1.89 lakh crore from 13.73 lakh crore in 1819 to 15.62 lakh crore. And uh, though it seems to be a positive development, but actually it is not, because this rise is not due to the increase in either deposit or investments, but because of the fall in the borrowing or the financial liabilities. And this sharp decline in borrowing led to the rise in net financial assets of the household sector. You can see there is a fall in the household savings in the bank deposit. It was 3.8% in 1819, fallen down to 3.4% in 1920. Similarly, savings in life insurance funds and mutual funds, it was 2.2% of GDP, which went down to 1.9%. In the same way, if you see the currency with the public, in 1819 it was 1.5% of GDP, which gone down to 1.4% of GDP till March 2020. So this is the status of financial assets of household sector. Now I'll take you to most important development with the currency with the public. You can see in this table that as on 31st March 2020, the uh, currency with the public was 23.49 lakh crore, which increased to 25.1 lakh crore as on 22nd May 2020. So there is a quantum increase in currency holding by the people, and this is because of sharp fall in spending due to lockdown and fear in the minds of people regarding future income and employment uncertainty. This increase in currency over the public for a common man may look good or positive development, but actually it is not the case. We know that the lower spending will lead to low level of income in the next round, leading to further slowdown in the economy. So what is the way out? Government needs to develop trust in the minds of people, create conducive environment for the businesses, and it can be done by giving more fiscal stimulus to the economy. So dear friends, if you like the analysis and would like to watch such videos in future, please subscribe and share with your friends. Thank you. Thank you so much. But don't forget to give your comments and feedback.